Everyone thinks Warren Buffett buys undervalued companies. They're wrong. He buys cash machines masquerading as broken businesses. Here's the trick. Buffett doesn't chase growth stocks or speculative turnarounds. He hunts for what accountants call predictable cash generation. When Berkshire acquired Nebraska Furniture Mart in 2011 for $60 million, most analysts saw a dusty regional retailer. But Buffett saw something else, a business that converts customer dollars into cash year after year with almost zero reinvestment required. That's Exhibit 1. Exhibit 2, the float strategy. Berkshire owns insurance companies Geico, National Indemnity, others. Customers pay premiums upfront, claims get paid later. In between, that cash sits in Berkshire's vault earning returns. It's a permanent interest-free loan from the public. Over decades, this float has grown to nearly $170 billion. That's not capital Buffett had to raise. It's capital the market handed him. Exhibit 3, the leverage play. Most acquirers use debt to finance deals. Buffett uses something more powerful, Berkshire's own stock and retained earnings. Because investors trust his track record, they'll hold Berkshire shares indefinitely. He doesn't have to service debt. He compounds returns on capital that costs him virtually nothing. Now the pattern becomes visible. Buffett acquires businesses with these traits: durable competitive advantages, brands or networks that customers can't abandon. Minimal capital requirements, no constant reinvestment to stay competitive. Predictable earnings, boring is beautiful. And here's the trick, he pays a reasonable price for certainty, not a speculative price for growth. When Berkshire paid $517 million for See's Candies in 1972, it seemed expensive for a regional candy maker. But See's had pricing power, customers paid premium prices for nostalgia and quality. Margins stayed thick, cash flowed reliably. 50 years later, See's has returned billions to Berkshire despite minimal growth. That's compounding at work. The economic principle underneath: Buffett exploits the gap between price and intrinsic value. He finds businesses where the market underestimates durability and misunderstands cash dynamics. Then he holds them, not for years, for decades. Compounding turns reasonable returns into extraordinary wealth. This is why Berkshire looks different from other conglomerates. It's not a portfolio of bets. It's a machine that converts ordinary capital into compounding returns through disciplined acquisition of predictable cash generators. That's how Buffett transformed a failing textile mill into a $500 billion holding company. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to decode the hidden economics behind the world's most durable business empires. There's a new case study every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.